Capitalight is a subscription research business. We sell commodity price forecasts and other proprietary information. It's our biggest customer base are actually the mine operators. Anybody here from a mine operator today? Okay. Our second biggest basket of customers are asset managers. Anybody here running a fund? Okay. And our third are investors who want to know that whether or not they make money on a gold stock or a silver stock or whatever, a lot of that comes down to the drill bit. But if it's an operator, it's also going to come down to whether the commodity price went up or down during the period you owned it. Anybody here own individual stocks? Perfect. All right, so we'll go for that kind of an audience today. So about us, we have different titles. One focuses only on the gold price, where it is, where it's going to be, why it is where it is. That's written by a legend in the business. His name is Dr. Martin Murenbield. I'm sure many of you have met him and seen him over the years. I guess if I go chronologically, our next title is The Economics Monitor, which is written largely by Chantal Skeven, who's in the back row here, who's a genius in Chinese and U.S. relations, as well as the economy, and she's our in-house Fed watcher. Chronologically, a third title then would be Silver Monitor, which is authored by Dr. Tom Brady. No, he doesn't play football, but he was the chief economist at Newmont Mining for 10 years before coming to work with us. The next one I think you'll see there is the critical metals for a sustainable world. That's copper, nickel, comment on lithium, as well as several of the other several rare earths. And that, I'm happy to say, is led by Patricia Moore, who's with us right now and has joined us after a couple of decades working at Scotiabank as the industrial economist. So I'm highlighting all of this to show you that this is serious work by serious people, offered at a great price for serious customers. All right, let's go. So I'm going to give you the exciting stuff first, and then we'll get into the weeds in the back end. So we're going to start with the price forecasts. For the end of 2023, gold, $2,000. For the middle of 2024, gold, $2,150. And those are what we're calling our base cases. So when you look at the image, you'll see, for example, on gold, the historical is the solid black line. That's where gold has been. Where you see the shaded section and an A going down, that's our worst case for gold. The B is our base case, that's what we expect. And the C is, this is how good it could get in our bull case scenario, okay? So the B there is 2150 by the end of next year. And then if we see any spikes, it'll probably be captured up to the C level. And we do these, that goes out for 6 quarters, and we update the forecast every quarter. And we also give you not only what the A and the B and C, so the bear, the bull, and base case are, but we also tell you what we expect the probabilities of each are, and then we put that into a final calculated number. And the reason why that's really important for people is, let's say you are running a mine, or you're a private equity investor, and you want to know that if you buy a mine, you're going to own the whole thing. You want to know that the break-even cost on that mine doesn't imply a gold price lower than scenario A, because if it does, you're going to lose money. That's the kind of work that we do for that kind of client, okay? Silver, $26.50 through the middle of 2024. That's our base case. Our bull case is $31 by the middle of 2024. And we don't ever see it getting back to $16 except for a cup of coffee. Those were the pre-COVID lows. It's probably not going to be down there ever again for any meaningful amount of time. Copper and nickel. Same concept where we've got our bull case, bear case, base case, or high, mid, low. Copper, you can see here, is today it's 365, and our mid 2024 forecast is 4.25. And we expect that to remain that level for quite some time. And then on nickel, around flat at $10. So why do we think these thoughts, and what goes into constructing our forecast, and what assumptions are we making that are inputs to all of these calculations? So we've, over this slide and the next one, we've got a couple more that are in there. So tight labor markets are going to keep inflation higher than 2% that the Fed is trying to get us back down to. And as we'll see in another slide coming up, high metals prices and inflation go together. And we could, at another time, we could argue about whether they're both driven by the same thing, which would be a third item, or whether one drives the other. But the point is that the higher the inflation measured in the economy, the higher the metals price you're going to get. Okay? China reopening is going to really kick in the second half of this year. And then over the long term, we're going to have demographic trends that are going to push the metals higher for longer. And we'll get into some of that in this deck here as we go quickly. Some food for thought. And if you, by the way, anyone who's interested in any of this, we do a free trial subscription. So either pick up a business card from our sales guy, Peter Sidlowski, right there. Raise your hand, Peter. Or go to our website and sign up, and you'll get everything free for a while and decide if you like it. Okay. There's a lot of implied things about the growth of EVs, and the supply constraint is going to be what both keeps prices up and will really control the rollout speed for that across the world. Okay. In the meantime, fossil fuels aren't really going away anytime soon. One more important thing here. See the copper grades? So halfway through down the screen here, declining ore grades with key infrastructure and new energy metals and minerals. When we talk about needing new mines, you got to remember that a mine that was built 20 years ago was on a higher grade than you can probably get now. So that's one of the things that's going to slow down this whole pace. Not every mine is equal compared to what was built 20 years ago or found 20 years ago. All right, let's continue. Inflation, this is just another way to say it's going to be off its peak, but it's going to be with us for a while. One of the things that will come from not only inflation, but oil and gas, natural gas, you'll see a better economy in North America than you will in Europe because the cost of industrial production, the cost of manufacture is going to be lower here for the time to come. A lot of that's going to be due to natural gas. So here's the chart I was telling you. The higher the inflation, the higher you're going to see in metals prices. And here are 3 different ways of measuring inflation: a 5-year break even, a 10-year break even, and a 5-year swap. Those are all derivative calculations that show you what the markets for money are implying that inflation will be. Why do we think metals are going to stay higher for longer? One of the important reasons: more people than ever. And then what we've done here is shown from one of the university studies in Ontario, where are the big cities going to be 27 years from now? And the answer is not in the places you're thinking about. So you'll notice that these largest 8 cities, I don't see a Chinese city in there, do I? All right, so China, right now people are talking about China's population increase has peaked out. Their population in total is starting to drop. Don't take that as a sign that metals are going to go down in price. There's all these other parts of the world that need to build out. And they're going to have people and people and people who do need to build out. And in the next chart, probably my favorite chart coming up soon, is you'll see an image of Africa and the electrical grid. Okay? I guess I read ahead too quickly. There it is. China's population has peaked, but that doesn't matter because Africa, specifically the Democratic Republic of Congo and Nigeria and several other countries, are going to be replacing that growth. So here it is, access to electricity. If you look on the right-hand side, the very part of the world that has all the population growth also has the weakest grid. So if you're going to be building a grid, you're going to need metals. Absolutely, you're going to need copper and nickel, and you're going to need them in ways that most people currently don't expect right now when they think about those copper metal drivers. Okay? And then the left-hand side shows electricity demand per wealth, essentially, per country. So as these other countries get wealthier, they're going to not only need the infrastructure, but they're going to demand more usage of it. So again, metals need will go up. Okay. Commodity supply. And we've chosen one example here. Commodity supply is not as easy as you think. You certainly have heard about it all throughout today and yesterday from everyone else speaking, you can find something. So I think Chevron discovered what we now call the Thacker Pass lithium mine. Originally discovered it over a 12-year period starting in 1975. It's still not built yet. It's not operating. We're not exactly sure when it will be operating. So we're highlighting this to point out that you can get a really interesting price move on metals that is required to induce production, which is different from the price metal required to just keep things in balance or in the degrading balance that they're already in. Okay. As we talked earlier about copper, same thing with gold, the exploration success is declining. We have to go deeper. We have to build lower grade mines. There's a physical endowment on the planet that mankind has already been exploring for, drilling and mining for thousands of years. Essentially, the easy stuff's been found. We either need to invent a new method, a new definition of easy, or we have to take on more complex, larger and lower grade projects. Okay? This is one of my favorite charts because everybody's talking about central bank demand. So in this case, in any particular year, the amount of gold available for sale, which we'll call the large pie chart on the left, has to equal the amount of gold consumed on the right by jewelry and investment and industrial uses, and the amount purchased or sold by central banks. So what you often hear now when people talk about de-dollarization, what they're talking about is the Chinese central bank is buying gold, or the Russian central bank is buying gold, or the Polish central bank is buying gold. In every year, things have to balance, and the way to think about it is the investment and the central bank ones are the ones that move around the most. And the other thing to think about is a large amount of the physical demand for gold comes from Asia, specifically India and China. So it's more culturally common to give physical metals as a gift in those countries than it is here. Okay? All right, here's some of our proprietary things, the things that we make and sell to our customers that nobody else makes. So you'll have heard the phrase, the window is open. The financing window is open. A company can raise money. Has anyone heard that phrase before? Does anyone know what it means? That's the tricky part. So we built it. We have an oscillator here that goes up and down around the zero line. The data goes back 23 years. And when the blue lines are very high, like 0.4 or above, we describe that as the window for financing equity exploration is wide open. Okay? And then when we're down low, and you can see the lowest point was 2016, the window is closed. That means you can't raise money even if you have a fantastic team doing their third successful company. They've got a fantastic project. There's infrastructure all around. There's simply no money to be had, okay? And what we do with this is the asset managers and the business development teams inside the operating mining companies, they use this to figure out whether it's cheaper for them to go raise new money and explore, or is it now cheaper to go buy some other company on the exchange and own their exploration because that other company is both cheaply valued and unable to raise money on their own. Okay, at the bottom of a bear market, whoever's got the money calls the shots. It's a little difficult of a concept, but it's very important. So, we need to have a better name for this. We always have a debate about the name for this chart. We call it the production imbalance indicator, which is very pretentious. Another way to think about it is the economics profits that a mining company makes. Okay, so when they're making a lot of money, you want to be a shareholder of them. When they're not making a lot of money, you probably don't. What we've done in the two circles is highlighted the time in history, and we're in one right now, where the companies are making a lot of money. And if you think about the income statement for a gold company, and we'll just pick on Newmont for a minute, their revenue line is really simple. It's whatever they happen to sell the gold at times the number of ounces they sell. That's super easy. And so we use the gold line on this chart to represent their revenue. It's the price of gold. The blue line, which jumps around a lot, so that's why we've given a pink shading around it, is their cost of operation, including the cost of CapEx to build the mine in the first place, or depreciation, or exploration drilling to keep the mine sustained or to keep the mill sustained. And that doesn't always get reflected easily in their accounting statements. So you need to understand what their true economic value added is, and that's what we do here. So we show that a lot of the time, say from 2003 when the data starts over to 2011, the gold price and their cost of operating the business, not just operating the mine, were roughly the same. And you didn't, during that period, you didn't get any big dividend hikes. You didn't get a lot of special payouts or anything like that. And it was a tough business. From 2011 until about, say, 2014 or 2013, they did a really great job of keeping costs in line while the gold price ran. And their margins were fantastic. Okay? Then that went away through the middle of the century, the middle of the decade, and it opened up again starting in 2019. Now it's starting to close down. Will it close? I don't know. It might get better again right away. But this is one of the things we're delivering for investors and prospective investors. They want to know when is the right time. And I would point out that where we are now, most of these gold companies have never been cheaper when you measure them on a dividend basis or a revenue basis or a price to book basis or an implied value basis, which will, I think, inform some of the upcoming charts we have next. All right. Has anyone ever heard the phrase, we are merging with another large mining company so we get large enough that we attract the attention of the generalist investors? You guys ever heard that? We're going to merge till we get big enough that Manhattan cares about putting money into us. I see some nodding heads. Okay, this is what they're talking about. What we do, and we do it for gold on the left-hand side, we do it for silver on the right-hand side, is an immense big data study. So we pull in all the data that's available about who owns these companies. And we break that down into different buckets. There are certainly some investors who are dedicated to the space and will always own things in the space. And therefore, you can think of them as not having a choice to go to any other industry. If you're in a Sprott precious metals fund, they're always going to own gold stocks or silver stocks. They can't go off into technology stocks. So they're not generalists, they're specialists. But the vast majority of money in the US and the vast majority of money in Canada are not specialists, they're generalists. They can own cigarette stocks one day and mining stocks the next month and technology stocks next year and housing stocks the year after that. And they move around looking for the best bargains and the best income available to them. So what we do is we track, collate, and calculate all that information to figure out how the generalists are thinking about mining right now. And as you can see, we go back all the way to 1998. On the gold side, they increasingly didn't care. And it went all the way to 2017, which is basically the bottom of the bear market for mining stocks. And that's when it happened. We're not back to, quote, they care, but it's not getting any worse. And it's been getting slightly better at a slow pace for the last 3 or 4 years. Okay. And on the other side, for silver, we can see the same thing possibly happening, but these are big changes. And once they kick in, you're going to get more and more investors, more and more adding on to this industry, and it'll run for many, 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 many years to come. So that's the generalist measuring. So free trials, visit us at the booth, talk to Peter if you want to try it out. I'm open for questions. I have thoughts, happy to talk with you over on the side, and I'll say that silver and gold are industries that are large enough with enough dedicated players that are already large enough market caps to have ever attracted generalists that we can do this kind of a study. If you look at the largest lithium companies, there was probably never a time when a generalist was the vast majority of the shareholdings and then it went down and came back up. So the calculation gets really, really hard over there and you're left with your gut feel. But I'll certainly talk about that with you. And maybe Patricia will come and join us on that too. Thank you very much for coming.